Hey, I'm Abe, and today we're going to talk about diversification. You've heard me use that word in countless videos before now, but we're going to get right into it today. Diversification is the act of investing in multiple different things to remove non-systemic risks from your portfolio. Diversification pays dividends over the long term. So what does that mean to invest in different things, and why does that matter? Let's go walk through a scenario. So let's say I really like Apple. I want to invest in Apple, so I put all of my money in Apple. If Apple does really well, great. I get to benefit from that performance over time. It's incredible. If they do poorly, I lose everything, right? And let's say maybe Apple goes out of business, it's all gone. So, okay, I want to diversify, and let's use that word. So I invest in Google and Apple, all right? So now I'm diversified away from just being in one company. But both of the companies I've chosen are tech companies. They're exposed to the same risks that generally, if Apple does well, Google may also be doing well, right? So now I'm still exposed to tech risk. Okay, so what about if I find different industries? So now I'm investing in Google and Apple and maybe Ford and Exxon. We're in the energy industry, we're in the transportation industry, we're in tech, and maybe we grab a couple more. Okay, so we've diversified out of our industries, right? Now, what about how big the companies are? I've listed off a lot of really big companies, but what if all large companies are impacted by something? So now I want to make sure I have not just a bunch of different companies that are all in different sectors and industries, but I want to make sure that I'm getting a mix of the size of the companies as well. And then I also need to worry that I'm only invested in the US. Well, what happens if, politicians pass really funky tax laws here, which they do all the time? So now I want to make sure that anything that only impacts the US won't completely destroy what I'm working on. So now I'm picking a little bit of investment in Japan and Europe and maybe even emerging markets down in, Brazil or India, for example. So you can see how the rationale works, that you don't just want to be invested in one thing, whatever it is. You don't want to be invested in one industry. You don't want to be only invested in one country. You don't want to be only invested in one company size. And you definitely also then don't only want to be invested in one asset class, which is kind of what we talked about on Monday. So by asset class, I'm talking cash as an asset class, stocks, bonds, ETFs, mutual funds, commodities, those are all asset classes, right? And so it gets a little muddy when you look at mutual funds and ETFs that are invested in stocks and bonds because, there's a lot of overlap there. But the way to look at diversification and the way to think about diversification is there is inherent risk in almost everything that you invest in. And there's ways to remove or mitigate a lot of that risk by investing in a lot of things that don't correlate one-to-one. The more you can find investment options that are negatively correlated, which means as one goes up, the other one goes down, the better off you will be in the long run. I'm not saying you should have 50% in one area that goes up and 50% in one area that will go down if the other goes up, because you'll always be, basically zeroing out. It's very difficult to find things that are 100% negatively correlated. So I'm not sure you would be able to, even if you wanted to, but small investments in negatively correlated options are a great way to set yourself up for long-term growth. So, all right, so diversification can help us with some things, but it can't help us with all things. What are some of those systemic risks that we can't diversify away? If you think about it, political instability, war, exchange rates, just to name a few, are some systemic risks. So if the overall world, if you look at what happened in 2008 as an example, you can see that the entire world economy just took a major hit. And so you can't mitigate that risk. You can reduce the impact that it might have on you by having a diverse portfolio, right? So if everything's going down, your portfolio is going to decrease or go down as well. But you can see, if you look back and dig through the numbers, that some locations performed better or lost less than, say, others, say in the US, for example. And if you were heavily invested in real estate, then that would have been a significant hit. Whereas if you were invested in other and a variety of different options, that those would have been offset as well. So you basically want to reduce the amount of hit that you would take at any given point, if possible. It's not possible to completely avoid ever losing money. You're always going to be following the same ebb and flow of the market. But diversification allows you to remove what risk you can and set yourself up for long-term growth. Hit me up in the comments if you want to see a mathematical example of this. I'll set it up in Excel and we can walk through it step by step. It's not too complicated to explain or to understand. So thank you for watching. Let me know what else you're curious about, and we will get into it next.